for a while, the stock and bond markets have been focused on three things: trade, the Fed, and corporate earnings. And today, all three issues collided. First, President Trump revealed that the U.S. and China still have a long way to go before the two countries reach a trade deal. And he warned once again that he's ready to slap tariffs on another $325 billion of Chinese goods. Second, a new report said that retail sales increased more than expected in June, an indication that the consumer is strong. That could change the calculus for the Fed and the likelihood of rate cuts this year. And third, earnings reports released so far have shown that consumer spending is strong, but business spending is slowing down. New reports like these can often change a long-held outlook for growth. So we asked Steve Liesman to put together a real-time assessment of the economy. And that's where we start tonight.
While everyone seems to be expecting the economic party to wind down or even end, no one seems to have told the U.S. consumer. The government reported June retail sales today up a strong 0.4%, beating expectations on the street. Consumers spent less money on gasoline, but plowed those savings into clothing and furniture purchases. Auto sales also did well, and internet sellers did a brisk business, seemingly at the expense of department stores. All this shored up views on the second quarter with the CNBC Rapid Update, the median of tracking estimates for GDP on Wall Street running at 1.8%. It's a slowdown from the 3% of the first quarter, but well above the worst fears that accompanied the beginning of the quarter and right about trend growth. Still, Fed Chairman Jerome Powell, in a speech Tuesday, continued to telegraph a rate cut coming from the Fed, as did Chicago Fed President Charlie Evans. In a CNBC interview, Evans said he was concerned about slowing global growth, the trade war, and inflation running below the Fed's 2% target.
With the most recent nervousness, I'd just say, I think that a little more accommodation would be helpful for ensuring that we confidently get to 2 and above 2%. I really think that 2.25 or a little bit more than that would be about appropriate for our economy and monetary policy. At this point in the economic cycle, we're 10 years into an expansion, and if we're ever going to be above 2% during this cycle, you would think this would be about right.
So consumers have enjoyed strong job growth and decent wage growth, and now they're likely to get a rate cut soon from the Fed. Doesn't seem much like the party, that is the economic expansion, is ending anytime soon. For Nightly Business Report, I'm Steve Liesman in Chicago.